Good morning, everyone. I'm Greg McKenna, and it's Monday, the 7th of September 2015. It's US Labor Day and a public holiday in Canada, but that doesn't mean it won't necessarily be an interesting day in Asian trade today. Shanghai's back after a couple of days off for the celebrations of the end of World War II. We've got an Aussie dollar down here at the lowest level, certainly the lowest weekly open since around April 2009. That's just after the acute period of the GFC. And we've also got a big week of data and events out in Australia today. If I just quickly recap on what happened Friday night, stocks ended in the red over the course of the week in every major market in Asia and the US and Europe. The Aussie market managed to buck that trend slightly on Friday afternoon, but the Nikkei was down 2.15. European traders took the bearishness and ran with it. All the major indexes there were down. FTSE was down 2.44, DAX was down 2.71, CAC was down 2.81. In Italy, stocks fell 3.18%. That meant that the US market opened up weak and continued weak, but US traders were a lot more circumspect. The Dow only fell 1.67%, the Nasdaq was down 1%, and the S&P 500 was down 1.54%. That was still a pretty poor week for stocks, though, and key to the moves were continued concerns about global growth. Over the weekend, even though G20 said that growth's weak, weaker than expected and will pick up, Christine Lagarde from the IMF highlighted that things aren't looking that rosy out there. That's what's underlying the stock market weakness. Sure, you could argue that there's fear of the Fed, but the reality is that with all the equity instability, if the Fed goes this month, and I think they should, they're probably going to go, it'll be one of those one and done kind of statements. We thought we just needed to raise, but there's no rush to raise again, that kind of thing. That could see a stock market rally, but it'll be a rally to sell. But we've got to wait another week, and so there could be more fractious trade over the next week or so. Non-farm payrolls on Friday night pretty much had something for everybody. 173,000 was the print. As expected, much weaker than forecast. I don't know why forecasters didn't figure out that maybe the last 3 years of seasonal misses was going to be the same again. But what we saw was a big miss. But there was upgrades to the previous months of 44,000. So that, together with a 5.1% unemployment rate, which is now in the Fed's full employment zone, really highlights that the time is now for the Fed to hike. Jeffrey Lacker, is it Jeffrey? Anyway, Richmond Fed President Lacker spoke before the release of non-farms and said it's time for rates to rise, and I tend to agree with him. I've said it here 1,000 times already. The US interest rates at 0% are completely incompatible with where the labour market is. And even though inflation's not a risk, you do need to start to take rates up a little bit. Even if they only take them up to 1% or 1.5% or even 2%, they can then start to come down again if the economy needs it. But where we are at the moment, they've got nowhere to go. Many of those who are saying that rates shouldn't go up are stock spruikers. And, I think they kind of lack some of the credibility that the bank economists who are not necessarily just spruiking stocks might have. And if you have a look on my 20 seconds piece or my Go Markets morning report this morning, so 20 seconds is a Business Insider, you'll see that I've linked to Miles Udland, who's one of the BI editors in New York, piece on what economists got to say. Anyway, on foreign exchange land, there's enough uncertainty out there and enough concern about what stocks are going to do that the US dollar hasn't actually picked up. Now, the reason for that is that the yen is a natural safe haven in times of market turmoil, and that's what we're seeing with continued falls in stock markets. And the euro, because everyone's been betting against it so aggressively, and there's so many shorts are out there, the euro is getting supported as well, because both capital flows come back to Europe, but also people cut their positions. So it ran up to 117. People thought, all okay. Ran back down into the 111s. Got a little bit of a fillip from the fact that people are just pairing those positions, because when markets go off, or when there's a risk that markets go off, traders don't get paid for having off-index bets. So if you've got an index and you think euro's going down, and it's a normal time of reasonable market volatility, in terms of usual market volatility, I should say, then you can be shorter than your index against euro and make extra money without taking terribly much risk. In these volatile times, however, you don't really get paid for that risk. And so people take those extra bets off the table. That's one of the reasons the Aussie dollar always gets thumped when it's times of market turmoil. People who are trading Aussie, because it is the fifth most traded currency on the planet, even though we're the 12th or 13th biggest economy, likely slipping down given we're now at 69 cents. People take those bets off and they go back to home. And that's why you see the yen always strengthen and euro strengthened a bit and the Aussie under pressure. Kiwi is also under pressure, getting slammed. Canadian dollar's back up at those, more than decade highs. So what we are seeing is we're seeing that the commodity block is once again getting smashed. Crude wasn't terrible. It was it's 45.77, so it's off the highs of last week, but not terribly so. And we've got gold down at 11.22. Gold stands in contrast. Gold, a bit like US Treasuries, stand in contrast to what's going on in stock markets and what FX markets are talking about. But I think people are just seeing better trades where they can make some money when it comes to market volatility. Over the weekend, I've mentioned about the G20, the Aussie dollar. Have a look at the piece I've written at Business Insider. In terms for the local ASX, the futures were down 20 odd points overnight to follow the 0.3% rally on Friday. The variable there, of course, is that part of G20 was that the finance minister said that the 7% growth rate is actually going to be hit, and that means that the government's going to increase stimulus or increase spending. That could help Shanghai today, which might help the local market, but overall, we remain pressured because the banks are under pressure from a weaker Australian economy, weaker earnings profile, and the miners, of course, are under pressure from weaker commodity prices. We're still in this basing pattern in terms of stocks and some of the commodity prices. We haven't taken out the lows, unlike what we've seen in the Aussie. So it's not a time to be uber bearish, but if you do see those lows get taken out, it could be that this is just the second. We've seen the second leg, and we're now into a deeper move. That's largely it for me today in trade. As I say, US is out, Canada's out. We've got AIG performance of construction in Australia, and then ANZ job ads. We've got German industrial production tonight, UK house prices, but that's largely it until tomorrow morning when things will kick off again. So that's me. That's Monday. Enjoy today's quiet trade, or what should be quiet trade, because the week really gets busy from Tuesday and Wednesday. And of course, everyone will be looking forward to the Fed's hike next week, and there's plenty of water to go under that bridge. So happy Monday, good trading, and I'll see you tomorrow. Bye for now.